What is the risk of a national credit rating downgrade? Imagine your credit score dropping suddenly. Now think bigger. When a country's credit rating drops, it can shake up the entire economy. That's what we call a credit rating downgrade. It's like a report card for a country's ability to pay its debts on time. If credit rating agencies see the country as less reliable, they lower its score. This signals that the country might struggle to meet its debt obligations. One big risk is that borrowing costs go up. When the rating drops, investors want higher returns to compensate for the increased risk. That means the government has to pay more interest on its bonds and loans. These higher interest payments can eat into the budget, leaving less money for things like roads, schools, or defense. If the government keeps borrowing more to cover deficits, the national debt can grow faster. Budget deficits happen when the government spends more than it earns. If a downgrade occurs, it can make deficits worse because higher interest costs add to the spending gap. This can lead to a cycle where more borrowing fuels even higher deficits. Over time, this can make it harder to control the debt level, which worries both domestic and international investors. Economic growth can slow down when borrowing costs rise. Businesses and consumers find it more expensive to get loans for expansion or big purchases. Slower growth means fewer jobs and less income for families. If the government has less room to maneuver because of a lower credit rating, it might have to cut spending or raise taxes, which can further slow the economy. A downgrade also signals concerns about how well the government manages its finances. If deficits stay high and debt keeps rising, it shows a lack of fiscal discipline. This can reduce confidence among investors and trading partners. It might even weaken the dollar's position as the world's main reserve currency, which impacts global trade and finance. From a Republican point of view, these risks highlight the importance of controlling spending and reducing deficits. They argue that unchecked federal spending and large tax cuts without spending cuts can lead to these downgrades. Republicans believe that restoring fiscal discipline can help avoid higher interest costs and keep the economy healthy. They see a downgrade as a warning that current policies are unsustainable and need to be addressed. In practical terms, a credit rating downgrade is a sign that the country's debt path is not sustainable. It urges policymakers to focus on balancing the budget over time. That means controlling government spending, reforming entitlement programs, and promoting economic growth. If these steps aren't taken, the country risks a cycle of rising interest payments and growing debt, which can limit the government's ability to fund essential services and protect national security. It's a wake-up call to make smarter fiscal choices now to keep the economy stable and strong for the future.